Modern portfolio theory is a theory of finance that attempts to maximize portfolio expected return for a given amount of portfolio risk, or equivalently minimize risk for a given level of expected return, by carefully choosing the proportions of various assets. Although MPT is widely used in practice in the financial industry and several of its creators won a Nobel Memorial Prize for the theory, in recent years the basic assumptions of MPT have been widely challenged by fields such as behavioral economics. MPT is a mathematical formulation of the concept of diversification in investing, with the aim of selecting a collection of investment assets that has lower overall risk than any other combination of assets with the same expected return. This is possible, intuitively speaking, because different types of assets sometimes change in value in opposite directions. For example, to the extent prices in the stock market move differently from prices in the bond market, a combination of both types of assets can in theory generate lower overall risk than either individually. Diversification can lower risk even if assets' returns are negatively correlated. More technically, MPT models an asset's return as a normally or elliptically distributed random variable, defines risk as the standard deviation of asset price fluctuation, and models a portfolio as a weighted combination of assets, so that the return of a portfolio is the weighted combination of the assets' returns. By combining different assets whose returns are not perfectly positively correlated, MPT seeks to reduce the total variance of the portfolio return. MPT also assumes that investors are rational and markets are efficient. MPT was developed in the 1950s through the early 1970s and was considered an important advance in the mathematical modeling of finance. Since then, some theoretical and practical criticisms have been leveled against it. These include evidence that financial returns do not follow a normal distribution or indeed any symmetric distribution, and that correlations between asset classes are not fixed but can vary depending on external events. Further, there remains evidence that investors are not rational and markets may not be efficient. Finally, the low volatility anomaly conflicts with CAPM's trade-off assumption of higher risk for higher return. A study conducted by Myron Scholes, Michael Jensen, and Fisher Black in 1972 suggests that the relationship between return and beta might be flat or even negatively correlated. Concept. The fundamental concept behind MPT is that the assets in an investment portfolio should not be selected merely individually, each on its own merits. Rather, it is important to consider how each asset might change in price relative to how every other asset in the portfolio might change in price. Investing is a trade-off between risk and expected return. In general, assets with higher expected returns are riskier. The stocks in an efficient portfolio are chosen depending on the investor's risk tolerance. An efficient portfolio is said to be having a combination of at least two stocks above the minimum variance portfolio, for a given amount of risk, and on a lot of assumptions about the probability distribution of returns on each asset. MPT shows how to select a portfolio with the highest possible expected return, under certain assumptions and for specific quantitative definitions of risk and return. MPT explains how to find the best possible diversification strategy. History. Harry Markowitz introduced MPT in a 1952 article and a 1959 book. Markowitz classifies it simply as portfolio theory, because there's nothing modern about it. See also this survey of the history. Mathematical model. In some sense, the mathematical derivation below is MPT, although the basic concepts behind the model have also been very influential. This section develops the classic MPT model. There have been many extensions since. Risk and expected return. MPT assumes that investors are risk-averse, meaning that given two portfolios that offer the same expected return, investors will prefer the less risky one. Thus, an investor will take on increased risk only if compensated by higher expected returns. Conversely, an investor who wants higher expected returns must accept more risk. The exact trade-off will be the same for all investors, but different investors will evaluate the trade-off differently based on individual risk aversion characteristics. The implication is that a rational investor will not invest in a portfolio if a second portfolio exists with a more favorable risk-expected return profile, i.e., if for that level of risk an alternative portfolio exists that has better expected returns. Note that the theory uses standard deviation of asset price fluctuation as a proxy for risk, which is valid if asset prices are jointly normally distributed or otherwise elliptically distributed. There are problems with this, however. See criticism. Under the model, portfolio return is the proportion-weighted combination of the constituent assets' returns. Portfolio volatility is a function of the correlations ρij of the component assets, for all asset pairs. In general, expected return, whereas the return on the portfolio, is the return on asset I and is the weighting of component asset. Portfolio return variance, whereas the correlation coefficient between the returns on assets I and j. Alternatively, the expression can be written as where for I equals j. Portfolio return volatility. For a two-asset portfolio, portfolio return, portfolio variance. For a three-asset portfolio, portfolio return, portfolio variance. Diversification. An investor can reduce portfolio risk simply by holding combinations of instruments that are not perfectly positively correlated. In other words, investors can reduce their exposure to individual asset risk by holding a diversified portfolio of assets. Diversification may allow for the same portfolio expected return with reduced risk. These ideas have been started with Markowitz and then reinforced by other economists and mathematicians such as Andrew Brennan, who have expressed ideas in the limitation of variance through portfolio theory. If all the asset pairs have correlations of zero, they are perfectly uncorrelated. The portfolio's return variance is the sum over all assets of the square of the fraction held in the asset times the asset's return variance. Efficient frontier with no risk-free asset as shown in this graph. Every possible combination of the risky assets, without including any holdings of the risk-free asset, can be plotted in risk-expected return space, and the collection of all such possible portfolios defines a region in this space. The left boundary of this region is a hyperbola, and the upper edge of this region is the efficient frontier in the absence of a risk-free asset. Combinations along this upper edge represent portfolios for which there is lowest risk for a given level of expected return. The tangent to the hyperbola at the tangency point indicates the best possible capital allocation line. Matrices are preferred for calculations of the efficient frontier. In matrix form, for a given risk tolerance, the efficient frontier is found by minimizing the following expression, whereas a vector of portfolio weights N is the covariance matrix for the returns on the assets in the portfolio, is a risk tolerance factor, where 0 results in the portfolio with minimal risk and results in the portfolio infinitely far out on the frontier with both expected return and risk unbounded, and is a vector of expected returns. Is the variance of portfolio return, is the expected return on the portfolio. The above optimization finds the point on the frontier at which the inverse of the slope of the frontier would be Q if portfolio return variance, instead of standard deviation, were plotted horizontally. The frontier in its entirety is parametric on Q. Many software packages, including MATLAB, Microsoft Excel, Mathematica and R, provide optimization routines suitable for the above problem. An alternative approach to specifying the efficient frontier is to do so parametrically on the expected portfolio return. This version of the problem requires that we minimize subject if a parameter. This problem is easily solved using a Lagrange multiplier. 2 mutual fund theorem. One key result of the above analysis is the 2 mutual fund theorem. This theorem states that any portfolio on the efficient frontier can be generated by holding a combination of any 2 given portfolios on the frontier. The latter 2 given portfolios are the mutual funds in the theorem's name. So in the absence of a risk-free asset, an investor can achieve any desired efficient portfolio even if all that is accessible is a pair of efficient mutual funds. If the location of the desired portfolio on the frontier is between the locations of the 2 mutual funds, both mutual funds will be held in positive quantities. If the desired portfolio is outside the range spanned by the 2 mutual funds, then one of the mutual funds must be sold short, while the size of the investment in the other mutual fund must be greater than the amount available for investment. Risk-free asset and the capital allocation line. The risk-free asset is the asset that pays a risk-free rate. In practice, short-term government securities are used as a risk-free asset because they pay a fixed rate of interest and have exceptionally low default risk. The risk-free asset has zero variance in returns. It is also uncorrelated with any other asset. As a result, when it is combined with any other asset or portfolio of assets, the change in return is linearly related to the change in risk as the proportions in the combination vary. When a risk-free asset is introduced, the half-line shown in the figure is the new efficient frontier. It is tangent to the hyperbola at the pure risky portfolio with the highest Sharpe ratio. Its vertical intercept represents a portfolio with 100% of holdings in the risk-free asset. The tangency with the hyperbola represents a portfolio with no risk-free holdings and 100% of assets held in the portfolio occurring at the tangency point. Points between those points are portfolios containing positive amounts of both the risky tangency portfolio and the risk-free asset, and points on the half-line beyond the tangency pointer. Leveraged portfolios involving negative holdings of the risk-free asset and an amount invested in the tangency portfolio equal to more than 100% of the investor's initial capital. This efficient half-line is called the capital allocation line, and its formula can be shown to be in this formula. P is the sub-portfolio of risky assets at the tangency with the Markowitz bullet. F is the risk-free asset, and C is a combination of portfolios P and F. By the diagram, the introduction of the risk-free asset as a possible component of the portfolio has improved the range of risk-expected return combinations available. Because everywhere except at the tangency portfolio the half-line gives a higher expected return than the hyperbola does at every possible risk level. The fact that all points on the linear efficient locus can be achieved by a combination of holdings of the risk-free asset and the tangency portfolio is known as the one mutual fund theorem, where the mutual fund referred to is the tangency portfolio. Asset pricing. The above analysis describes optimal behavior of an individual investor. Asset pricing theory builds on this analysis in the following way. Since everyone holds the risky assets in identical proportions to each other, namely in the proportions given by the tangency portfolio, in market equilibrium, the risky assets' prices, and therefore their expected returns, will adjust so that the ratios in the tangency portfolio are the same as the ratios in which the risky assets are supplied to the market. Thus relative supplies will equal relative demands. MPT derives the required expected return for a correctly priced asset in this context. Systematic risk and specific risk. Specific risk is the risk associated with individual assets within a portfolio. These risks can be reduced through diversification. Specific risk is also called diversifiable, unique, unsystematic, or idiosyncratic risk. Systematic risk refers to the risk common to all securities, except for selling short as noted below. Systematic risk cannot be diversified away. Within the market portfolio, asset-specific risk will be diversified away to the extent possible. Systematic risk is therefore equated with the risk of the market portfolio, since a security will be purchased only if it improves the risk-expected return characteristics of the market portfolio. The relevant measure of the risk of a security is the risk it adds to the market portfolio, and not its risk in isolation. In this context, the volatility of the asset, and its correlation with the market portfolio, are historically observed and are therefore given. Systematic risks within one market can be managed through a strategy of using both long and short positions within one portfolio, creating a market-neutral portfolio. Market-neutral portfolios, therefore, will have a correlations of zero. Capital asset pricing model. The asset return depends on the amount paid for the asset today. The price paid must ensure that the market portfolio's risk-return characteristics improve when the asset is added to it. The CAPM is a model that derives the theoretical required expected return for an asset in a market, given the risk-free rate available to investors and the risk of the market as a whole. The CAPM is usually expressed. Beta is the measure of asset sensitivity to a movement in the overall market. Beta is usually found via regression on historical data. Betas exceeding 1 signify more than average riskiness, in the sense of the asset's contribution to overall portfolio risk. Betas below 1 indicate a lower than average risk contribution. Is the market premium, the expected excess return of the market portfolio's expected return over the risk-free rate. The derivation is as follows. The incremental impact on risk and expected return when an additional risky asset, A, is added to the market portfolio, M, follows from the formulae for a two-asset portfolio. These results are used to derive the asset-appropriate discount rate. Market portfolio's risk equals. Hence, risk added to portfolio equals, but since the weight of the asset will be relatively low, i.e., additional risk equals market portfolio's expected return equals. Hence, additional expected return equals if an asset, A, is correctly priced. The improvement in its risk to expected return ratio achieved by adding it to the market portfolio, M, will at least match the gains of spending that money on an increased stake in the market portfolio. The assumption is that the investor will purchase the asset with funds borrowed at the risk-free rate. This is rational if, thus, i.e., is the beta return, the covariance between the asset's return and the market's return divided by the variance of the market return, i.e., the sensitivity of the asset price to movement in the market portfolio's value. This equation can be estimated statistically using the following regression equation, where alpha I is called the asset's alpha, beta I is the asset's beta coefficient, and SCL is the security characteristic line. Once an asset's expected return is calculated using CAPM, the future cash flows of the asset can be discounted to their present value using this rate to establish the correct price for the asset. A riskier stock will have a higher beta and will be discounted at a higher rate. Less sensitive stocks will have lower betas and be discounted at a lower rate. In theory, an asset is correctly priced when its observed price is the same as its value calculated using the CAPM-derived discount rate. If the observed price is higher than the valuation, then the asset is overvalued. It is undervalued for a too low price.